Now let's turn to our business segment now with Charles Pellegrin, and let's talk about something that's very interesting analysis, statistics coming out. This is from the European Bank for Reconstruction and Development. What's going on?
Well, they're releasing their new forecasts for growth in the regions that they cover this Wednesday. The bank, founded in 1991 after the fall of the Soviet bloc, has as its mission to help build up market economies in that region. And the new forecasts really show the contrasting fates of the countries in the region in the wake of that war in Ukraine, while we're seeing countries in Central Asia, the Caucasus as well as Turkey, maintain strong growth in 2023 through 2024. Countries that are part of what is referred to as emerging Europe are predicted to show weaker performances. Let's point out some of the figures you can see here on the screen. Central Asia is predicted to see growth reach 5.7% this year and 5.9% next year. Meanwhile, Central European and Baltic states, a group that includes, for instance, Poland or Estonia, for instance, will see growth of just 5.5% this year and 2.5% next year. Well, to help us sift through the EBRD's findings released this Wednesday, we're joined from London by Beata Javorcik. She's the bank's chief economist. Thank you very much for being with us on France 24. First off, what are the reasons behind this difference in prospects for example, Central Asian nations on one hand, or Turkey, and Central European nations on the other?
Well, it is a difficult year for Central Europe. On the one hand, we see weak performance of Germany, which is translating into lower demand for exports from Central Europe. Inflation, which was much higher in the region than in the West, eroded household budgets and put brakes on consumption. And of course, continued uncertainty due to the war was detrimental to investment. Now, in contrast, in Central Asia, government spending, exports of commodities, but also flows of capital and remittances from Russia, as well as the region serving as an intermediary for flows of trade from Europe to Russia, has helped accelerate growth. So strong performance in Central Asia and a difficult year for Central Europe.
It seems like what we're seeing here is that countries that have opted to maintain their trade ties with Russia as they were before the war are now benefiting from that choice more than countries that have decided to change tack. Is that a fair assumption, or a bit too quick of an assumption?
Well, there is indeed something to that. European and American exports to Russia dropped very dramatically, and we saw entrance of new players. So, for instance, Turkey increased its exports to Russia, as did China. So goods that used to flow from Europe to the Russian market, the same types of goods are flowing now from Turkey and China.
We're also seeing, and you mentioned it in your report, a decrease or a slowing down of industrial output in Central Europe in countries like Poland. What are the reasons behind this?
Lower demand for exports, particularly from the West. Also, remember, in Europe, we saw record high prices of natural gas. Now, these prices are back to the pre-war levels, but they are still 4 times as high as prices in the US. So this is eroding European competitiveness. And the markets expect a slight uptick in prices towards the end of the year.
You've mentioned about, let's turn to Ukraine now. Obviously, when it comes to their growth prospects, the forecast is for 1% growth this year and 3% growth by the end of 2024. What does that tell us about the state of Ukraine's wartime economy?
Well, let me put these figures into perspective. Last year, Ukrainian economy shrunk by about a third. So in a sense, it will be maintaining the level of GDP, taking into account that giant dip. But what's very encouraging is the fact that the Ukrainian authorities managed to maintain macroeconomic stability. To a large extent, it is due to the IMF program and flows of official funding, including from the EBRD, and that alleviated pressures on exchange rate and boosted reserves. Also, Ukraine saw a big drop in inflation. In December, inflation there was close to 27%. Now it's somewhat above 8%. So that's really important to maintain macroeconomic stability, because that makes lives for ordinary people more bearable.
And meanwhile, we also have to talk about the other side of this conflict. Your predictions for Russia with 1.5% growth this year and 1% growth next year. Is this the result of sanctions hitting, or the relative now isolation of Russia on the global trade stage?
Well, Russia has been sanction-proofing its economy from 2014. So they were able to maintain macroeconomic stability. They also still managed to enjoy high revenues for their carbohydrate exports. We were hoping that the price cap would work well, but actually recent analysis by the Kiev School of Economics shows that actually a lot of Russian oil is sold above that price cap. And, as they trade less with the rest of the world, they engage in import substitution and produce more themselves.
Beata Javorcik, you are the chief economist of the European Bank for Reconstruction and Development. Thank you very much for being with us on France 24. I'll hand it back over to you, Gavin. I'll encourage our viewers to seek out this report by the EBRD for a number of predictions, especially also it's a bank that has operations in North Africa as well. Lots of interesting findings in there.
Just really interesting to follow the money in the wake of the Ukraine war as well. Charles Pellegrin from our business desk, thank you.